Hey, Professor Sweet, how's it going?
Hey Ben, how you doing?
Doing good, doing good.
Remember when we were working on a bootstrapping yield curve?
Yeah, I do remember.
Let's
Yeah.
see how much of that you remember. So I use Bloomberg. I use this function, which is the yield on the securities. Here's the securities I brought in. This is
The
the
10-year,
ticker. Yeah, for governments, for U.S. governments, 10-year,
5-year, and
5-year.
then 10-year tip, and then 5-year tip.
Yeah, the inflation linked bonds. This is their current yields, 3.95 for the 10. So what we want to ask the question is, and here's the formula that we use to bring those in, the BDP function. I'm not on a Bloomberg machine here, so I can't use it, but you can still do that function if you're on a Bloomberg machine. So what we're asking is, what does the bond market think interest rates will be? So as you remember, we talked about you could buy one 10-year bond today, or you could buy two 5-year bonds, one 5-year bond today, and when it matures, buy another 5-year bond. And because of that, because you can buy the 10-year or you can buy a 5-year now and another one in 5 years, the bond market tells you this is what we think interest rates are going to do because you should be indifferent between these two transactions. We talked about, if the 10 years at 395 and the 5 years at 355, what does that say the market thinks the 5-year bond rate will be in 5 years, higher or lower?
Higher.
Higher than the 395, right?
Yeah, to
So
match up to the 10-year.
right. So if you only made 355 for 5 years, you have to make much more than that for the next 5 years. So we had it set up here. So if you invested $1 at 3.95% for 10 years, in 10 years, you'd have $1.43. If you buy a 5-year bond and make 355 for 5 years, in 5 years, you have a dollar 19.191. If we take that 5-year maturity, 1.191, and invest it at some interest rate for 5 years, we should have the same rate as we had with the 10-year to be indifferent between the two. So what does this rate have to be so that we get the same return between the 10-year and the two 5 years? And as you were saying, this has to be much higher than the 395 if we only made 355 for 5 years. So let's see. You remember the formula? So there's the formula there, right? Yeah. All right. All right. So we'll take $1 times 1 plus the 3.95%,
3.95.
raise that to the 10. That gives us that 1.473. I'll go to three decimal places. The 5-year, we do 1 times 1 plus the 5-year rate, raise to what?
To the fifth.
To the fifth. And that
Because
should
it's
give
five
us,
years.
yeah, for 5 years. And so the question is, what does the bond market think the 5-year treasury rate will be in 5 years? That's the 5-year forward, 5-year yield. It gets a little confusing because it's a 5-year bond and the difference between 10 and 5 is also 5. So, but we can talk about other ways you can do it. So how do you do that? Well, we need to solve for this percent.
Yes,
And
sir.
how do we do that? You take the 1473 divided by 1.191, raise it to the 1/5 minus 1, and you just have to trust me, that gives you that number. So if we take the maturity value of the 10-year divided by the maturity value of the 5-year, raise it to 1 divided by here.
5.
You can think of it as at 5, or you can say it's the longer bond, the 10-year minus the shorter bond. So it's 5, not because it's a 5-year treasury, it's 5 because 10 minus 5 is 5. And then minus 1, and that will tell you, well, I think you said that earlier, that should be about 4.3% or so.
4.35.
So if you were to take one 1.191 and invest it for 5 years at
You
1.0435,
should get 1.473.
and there it is, 1.4. So it works. So the actual formula is for the forward rate, it's 1 plus the 10-year yield, raise it to 10, divided by 1 plus the 5-year yield, raised to the fifth. You're going to take all of that and raise it to the 1 divided by 5.
Minus 10.
minus Y.
Oh.
And that's the forward rate. There's the formula for forward rate. So what do we do with the tips? Well, we can do the exact same thing with the tip.
What is the tip, Professor?
The tip is
Tips.
the tip is a bond where the government pays you 1.67% plus they're going to add inflation. So this is really the real yield of interest. This is the interest rate without inflation. This bond's going to pay you 3.95% no matter what inflation does. It's like what we call the nominal yield. This is going to pay you 167 plus what we think inflation is. So this bond is not only telling us what we think interest rates are going to do, it's also going to tell us what the bond market thinks inflation is going to be, which is a really great number, right? So we'll do the exact same thing we did before. 1 times 1 plus the 10-year tips yield raised to the what? To the 10th. And we'll do the same thing with the 5. 1 plus the 5-year
Raised to the 5th.
raised to the 5th.
Not the 5th, yeah.
And so we're going to ask, what will this tip yield be in 5 years? Obviously, it has to be much higher than 167.
Yeah.
So if we take the 10 divided by the 5, and again, raise it to the 1 divided by 10 minus 5 or 5 minus 1 should be like 230 or 220 something. So there's your forward rate. And so what does this tell you? Well, in 5 years, we think the 5-year bond is going to be yielding 435 on a nominal basis. But the real yield, we expect it to be 215. What does that mean expected inflation is going to be?
215 minus 4.3.
Well, the other 415, 435
yeah.
minus 215.
That's what I meant.
So the bond market thinks inflation in 5 years, for years 6 through 10, will be 2.2%. If your boss says, hey, I need a forecast of interest rates, you can say, well, I can let the bond market give me the forecasts. Your boss says, hey, I need a forecast of expected inflation. The bond market can give you that. I think we talked, why is the bond market a good forecasters versus going and paying an economist to do it?
Because it has skin in the game.
Skin in the game. If they're wrong, they lose money. So what could you do with this information? If you think the 5-year rate's going to be much higher than that, then buy the 5-year today, short the 10-year, and you'll make a lot of money in the future. Because this 10-year, if you short it today, you'll buy it back in 5 years. Well, if in 5 years interest rates are much higher, in 5 years, this 10-year bond will now be a 5-year bond, but the yield will be much higher. So you'll be able to buy this back at a discount. If you think the interest rate is going to be much lower in 5 years, say 3% or something, then buy the 10-year and short the 5-year. Then the 10-year will have a big gain in 5 years. So you can make money. You better be right, because if you're not right, you lose a lot of money. But you can actually, not only is the bond market telling you what they think interest rates are going to be, but you can actually bet against them by going long the 10-year or shorting the 5 or shorting the 10-year going long. So you buy the 10-year if you think interest rates are going to be lower in the future, and short the 5 if you think they're going to be higher, then buy the 5-year and short the 10-year. Yeah, it's really impressive stuff. What do we call this? Bootstrapping.
Bootstrapping.
The yield curve. Good job, man. You're remembering it.
Thank you, Professor.